This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. A white paper rolls into me unexpectedly, where somebody sent me the article, and I kept digging through the article to eventually find the white paper. Titled, 3 Decades Later, The Life Experiences and Midlife Functioning of 1980s Heavy Metal Groupies, Musicians, and Fans. Ladies and gentlemen, that means me. For somebody who has been to, back in the day, Iron Maiden, Van Halen, Ronnie James Dio concerts, that clearly fits me. Especially since I was in high school in the early 1980s, mid-1980s. The psychologists out there that apparently had too much time on their hands somehow or another decided to look at what became of those people that had those heavy metal tendencies back in the day. It turns out we're all happy today. I mean, that's the long and short of it. But there's a certain happiness apparently amongst those of us that listened to some metal back in the early 80s. And to quote from the white paper, youth form their sense of self through active reflection, trying on new hats, and assimilating the values of groups to which they belong, even if those groups are dark or not mainstream. I thought that summed up great, perhaps my attraction for metal music in the early 80s. Not rebellion just for the pure sake to be rebellious, but no. Me personally, I knew that many messages, many things that I was learning at that point in time, without having a full understanding of the playing field, were 100% agenda-driven, people pushing me to a certain direction and not giving me the full story. Perhaps what this white paper lays out quite clearly is that metal was the place for rebels to feel connected. And when you don't know what the playing field is, and you're a young person, the music's kind of cool, you're in. It interests you. It interested me. I can still remember Tipper Gore, the wife of Al Gore, who almost became the president of America. Tipper Gore was trying to ban heavy metal music back in the day in the early 1980s because it was devil music, and that anybody that listened to this type of music was possibly going to go to, quote, hell. It was entirely insane in America at that point in time. So, of course, anybody like me that would see this messaging, not only was the wider messaging clearly agenda-driven, but now they were taking on the music itself and saying that somehow or another, if I listened to Judas Priest or Iron Maiden or Black Sabbath or Van Halen, that somehow or another I was now this evil incarnate. So to roll forward to this white paper today in 2015, and apparently there's some good psychological research that identifying with the metal music and those that identified actually have found very nice happiness. I just thought that was a cool open, a cool way to bring into where I want to go today. Those of you that listen to my podcast should know by now that I don't like it when facts are rejected. I'm not a big fan of those of you out there that just want to buy into charisma for the sake of charisma. You'd rather have the romance of lies than know the truth. I'm not saying you as in all of you, but many people out there, they want the deception. They want to be deceived. In the last few weeks, I've learned that a trading author, a name that I won't mention, but one that is easily learned, has been arrested 4 times in the last year. Now, this doesn't surprise me. I've followed this character for a long time as part of my writings and part of my research. Quite frankly, it's one of those things that I love to expose. Something that's not accurate, something that's not true, and showing people, hey, look, here are the facts. Now, I know my work has shown a great many people the facts, and they perhaps changed their perspective. But maybe, and I don't know the exact numbers, maybe just as many of those people would see the facts and say, I don't care. Michael, I don't care that the person you're talking about is possibly a con artist. I don't care that this person has been arrested 4+ times in the last 2 years, and who knows how many other times. That's immaterial to me. In fact, I think Bernie Madoff got a bad deal, Michael. Michael, I want to forgive everybody. Michael, I'm into kumbaya. Michael, I just want to hold hands. Michael, why are you so zealous in your pursuit of the truth? So why can't you just let these people that are con artists be con artists? Why can't you just let them drive the lambs to the slaughter? Well, of course I can. Look, I'm like you too. I like to watch people that just give their brain over and don't ask questions, don't critically think. There are, however, a few people out there that just don't know. They just don't have all the information. But I just enjoy and have enjoyed since putting my first website up in 1996. I've enjoyed the act of putting the spotlight on a fact or on the truth. That's exciting to me. It's still exciting to me. Exciting might sound like an odd word, but to me, it's exciting because if so many people have an incorrect view, a wrong view, it's always fun to walk into the room and show better. Not because I've got this massive ego that I'm trying to be right, this or that. No, it's just sheer raising human ingenuity up, raising human progress up, and moving the bar further along. It's natural selection. It's evolution. That's what this is all about. My main example I want to talk about today is an article that I spotted in Forbes, written by Kai Trang Ho, titled, What Jurassic World Can Teach Investors About the Stock Market. She says, like the sci-fi amusement park in Jurassic World, Wall Street has to engineer new assets every year to attract investors. Financial firms create mathematically modified funds with proprietary formulas or quantitative algorithms that manage to beat the stock market in backtests. But the industry graveyard attests to the reality that simplicity trumps complexity. Financially engineered assets often fail to perform as their creators intended, or they're ill-equipped to deal with unanticipated events. Ultimately, hedge funds, mutual funds, and exchange-traded funds have to destroy their own creations to save themselves from ruin. That's her opening paragraph. I can only think of one group of hedge funds that talk about being quantitative, that talk about being systematic and algorithms, that have been doing it for decades. There's only one group. It's trend following traders. And whether that's called in public CTAs or managed futures, systematic quant trading, whatever you want to call it, trend following traders are it. So as I start to read her opening paragraph, I'm like, ooh, this is going to be interesting. She's going to dive into trend following. Actually, it turns out to be an interview. It's an interview with a gentleman named Ben Carlson. He's got a new book out. Right off the bat, the title of the new book jumps out at me as like, wow, okay, I already think I'm on the same page, the same alignment with Ben. A Wealth of Common Sense, Why Simplicity Trumps Complexity in Any Investment Plan. Who in the world can disagree with that title? Fantastic title. Now, I've not had a chance to speak with Ben. Perhaps he'll be a good guest to my show. I've not asked him. This is more about me looking at an article and looking for the truth and looking for the deviations from the truth in the article. She starts the interview by asking, what do you mean by complex strategies and what do you mean by simple? And why is simple better than complex? I'm already in love with her. She's asking the right question. I don't know what the answer is going to be. I'm going to read the answer in a second. That's exactly the way to think. Simple is better. Now, if I go back to her beginning opening paragraph, taking pot shots at quantified strategies, systematic strategies, etc., most of those, the best ones, the ones with longevity, are rather simple. Back to her question, what do you mean by complex strategies and what do you mean by simple and why is simple better than complex? Ben Carlson responds, complex strategies are anything that allows investors to try to get too clever with their portfolios. This includes overtrading, paying high costs for sophisticated strategies, trying to outsmart the market over the short term, changing your investment process or philosophy constantly, making excessive ad hoc decisions, and looking for the holy grail of investing strategies. I sure as hell don't know any strategy where all of those things apply to. I absolutely agree 100% with Ben. Overtrading, bad idea. Trying to outsmart the market. First off, we need to define what the market is. We probably need to define what outsmart means. Trying to outsmart the market over the short term? Absolutely. If I'm just taking that as general language, how can I not agree? 100% accurate. Looking for the Holy Grail? There is no Holy Grail. Like I said, I don't know Ben, but I'm already feeling like, well, okay, I like this perspective. I like where he's going on this because generally, without knowing specifically what he's talking about, we're on the same page. The questions to Ben continues. How do you recommend investors build their portfolios? Ben Carlson responds, you always have to start by considering your own personal risk profile and time horizon. This includes both your need and ability to take risk as well as how much risk you prefer to take. This should guide all future asset allocation and investment decisions with regard to how much risk, liquidity, and growth is necessary from your portfolio. He brings up some great points. But if you don't reduce risk to a number, like I have $100, I'm willing to lose $10. I'm willing to risk $10. You've got to be that definite. Because if you leave this idea of risk to the public, up to their imagination, how are people going to know what to do? Risk has to be defined. Absolutely defined. And then once you define it, there's no way that risk and reward are not related. So if you define your risk as X and you want your reward to be this, well, if you redefine your risk as Y, then your reward is going to be this. They're connected. They're each side of the same coin. They can't be disconnected. Let me continue with the next question from Kai Trang Ho to Ben Carlson. What is the proper way, proper in italics, what is the proper way for investors to view the stock market and their portfolios? Ben Carlson responds, think of shares purchased in the stock market as minor ownership in both the future earnings and dividends of the corporate world. The long-term trend has always been higher, but from time to time, human nature will affect how much people are willing to pay for those earnings and dividends. Stocks should be thought of as long-term investments. Think years or decades, not months or quarters, to benefit from their appreciation. Typically, stocks are used to compound money over time, while bonds are used to preserve it. Now I'm starting to feel like I've got a difference of opinion. First off, the long-term trend has always been higher. None of us live forever. Look at the Japanese stock market. Look at the NASDAQ. The NASDAQ's just got back to highs after 15 years. Because what Ben is talking about really in that paragraph is buy and hold. That's the only option that's presented, is buy and hold. You're left to the mercy of the market. If you're a Japanese stockholder today, You're still 50% down from the 1989 high. That's a long wait to be 50% down. What's the guarantee that if you take a buy and hold position in U.S. stocks today, that 25 years from now, it's going to be higher? There is no guarantee. If there is no guarantee, why not choose a strategy, an alternate strategy? And look, I'm not going to give you an alternate strategy that has a guarantee either, but I'm going to give you something a little more real. I'm going to give you an alternate thinking that's a little more real, that takes into account that not every investor is completely comfortable being saddled with the exact average of their neighbor in the exact cul-de-sac with the exact house and the exact car and the exact 2.5 kids and 2.5 dogs. Some people out there want above average. They want to shoot for something more in life. Because like I said, look, the Japanese stock market investing public, if they just trust the average, they've been shit out of luck for 25 years. So why be average? There isn't a piece of literature in this planet that says, for the limited time that we have on this planet, you should shoot for average. What is the point of shooting for average? Yes, if you take higher risk, you can get possibly higher reward. You also can lose more money. But higher risk and higher reward compounded will beat the average over the long term. Absolutely. Look at the number one stock investor that we all want to look towards in America. Warren Buffett knows one damn thing deep in his gut. He knows that he wants double-digit percent returns, over 20% if he can get it, and he wants to compound it. And to get that, Warren Buffett knows that he's going to take 50% drawdowns. He knows he will lose 50% of his capital at some point in time because he's trying to get rich. Why do we all pay attention to Warren Buffett? We pay attention to Warren Buffett because we're all trying to get rich. And then we turn around and we pretend, oh, you know what? Let's just buy the average and sit back in our matrix-like cocoon, sucking on the teat of whatever the government gives us, and we'll just be happy. So if I go back to that question, and excuse the momentary diversion that I just took there, but if I go back to that question, she asks Ben, what is the proper way? She asks it in quotes. Well, there is no proper way. There is absolutely no proper way on how to invest or how to trade. It's going to come down to you doing your homework, determining what risks and rewards you want to shoot for. Then that's it. You make the decisions, you go. Don't think like your neighbors. You're not your neighbors, you're you. Another question. What is the best way to make use of a financial advisor or consultant? Ben Carlson responds, the very best advisors should act as something of a behavioral psychologist, an educator, and a financial expert. They should help you set reasonable expectations, create a sound investment policy statement, and ensure that you're able to follow through with a long-term plan. They should also be very good communicators, but even better listeners. An advisor cannot make promises about the future with any certainty, but they should do their best to give you the highest probability of meeting your goals and desires. And their biggest job may be keeping investors from getting in their own way and avoiding huge mistakes at the wrong time. There's absolutely nothing that I can disagree with Ben in that statement. That is just pragmatic, sound advice. Well, actually, there's one thing I can disagree with. There is no person that you can hire that will do those things for you. I repeat, there is no person that you can hire that will do those things for you. It does not exist. You have to do those things for yourself. It's your responsibility to be your own behavioral psychologist. You can't pay an advisor to do that. And if you think you can pay an advisor to do that, you're drinking Kool-Aid. Now you might be thinking to yourself, but Michael, you have many professional trend following traders on your podcast. They would all like to raise assets. They would like to raise my assets. My interest is in the subject of trend following trading. I think it's a fantastic subject because it encompasses so many different variables, from thinking about the economics behind it, the behavioral psychology behind it, the technique behind it. My interest is not in hedge fund management. That's not my interest. Now, of course, I've met some fantastic fund managers, brilliant people, honorable people. But their business of expanding their business, that's their business. That's what they're trying to do. You have to make the decision that if you determine a particular type of strategy, you have to decide, will I execute that strategy by myself or will I hire someone? And it's very different to hire an advisor, a financial advisor that you don't actually put your money with, somebody that just gives you consultation, versus making an allocation to a trader who will trade your money for you in a systematic fashion, following rules in a religious way. Those are two different beasts. And they're personal choices. They're absolutely personal choices. Nobody can make them for you. But I just don't see what the financial advisor direction does for most people. Because ultimately, you have to know what you want. And if you're just trusting someone else to make those decisions for you, and again, I'm drawing a distinction. I think giving your money to a professional trading advisor is quite different than listening to a financial advisor give you assorted options. The questions continue. What are the necessary traits to be a successful investor? Ben Carlson responds, an investor needs to have enough emotional intelligence to understand themselves and their own personality when constructing an investment plan. They also need patience, the correct temperament, the ability to admit their own limitations, an understanding of financial history, and the discipline to stick with a strategy over the long term. Hey, that is spot on. Look, and I'm not attempting to pick on Ben. I've not met Ben, and perhaps, like I said, I need to get him on my podcast. He seems like he's got some really grounded thoughts here, and I cannot disagree with a word in that statement. Just to add the caveat, though, that it has to come down to you. You have to know what your plan is. You have to know what your risk is going to be. You have to know what kind of goal you're shooting for. And you can't trust other people to think for you. You've got to do it. One last question from the article, and this one perhaps is the most controversial and brings me back to the very beginning of this piece that was hinting about algorithms and quantitative strategies without naming trend following and without really going into any detail. Look, you can go back and find writings in the 1800s about being systematic. Systematic is a smart way to trade. And if you can automate your systematic strategy using technology, all the better. The last question. You claim one of the stock market myths is that commodities are a good long-term investment. Why is that a myth, and what is the truth about investing in commodities? Ben Carlson responds, over the long term, commodities have stock-like volatility with returns not much higher than T-bills. This means they are better suited for trading than investing because they go through extreme boom-bust cycles. Commodities can help in a highly inflationary environment such as the 1970s, but the majority of the time, investors will be disappointed in their returns. Plus, there are so many more speculators in commodity markets now than in the past that any risk premium earned in past decades has probably been compressed. If you think about it, a long-term bet on commodities is a bet against technology innovation. While we need and use resources, I like to think that innovation wins out in the end. And that was the final answer from Ben Carlson to the commodities question. So this commodities question, if you're an investor out there and you're taking long-only positions in, quote, commodity ETFs, are you brain dead? Seriously, why would you be a buy and hold investor in commodities? All you have to do is like the minimum amount of historical research to look at the volatile nature of commodity markets. And I'm talking about currencies, bonds, agriculturals, corn, coffee, orange juice, palladium, gold. These are all commodities. They go up and they go down. And they are the lifeblood of great trend following strategy. Because see, there's quite a difference that if you just want to talk about the market and say commodities, then if you say commodities traded as a trend following trader, these are two different worlds. Just a long only investor in commodities is like saying, I'm really stupid. I have no clue what I'm doing, but Wall Street has created this great new thing called long only commodities, and I'm buying because I'm brain dead. Or, wow, this is an interesting strategy over here. The trend following strategy is very effective trading commodities markets. Look at the returns over the last 50 years. Two different worlds. And look, again, this is not a beat Ben up podcast. I don't know Ben, and he's 100% right in this last passage because I assume he's talking about the idea of commodities only investing, commodities only, long only investing. In that last part of the answer, he also brings up the notion of speculation and more speculators in commodities. Look, commodities is about hedging and speculation. Different people go to commodities markets for different reasons. Trend following is speculation, and trend following is trying to capture that hedger premium. That's what you're trying to capture. But I just want to be accurate when we think about speculation in commodities markets. I would impress upon you, if you really want to know more about commodity futures trading, go to the CME website. Read some about the historical nature. Read how commodity futures markets operate. Read about who benefits from them. These are not just trading vehicles simply for speculation. Many large corporations are using commodity markets for hedging purposes. Farmers, large ag companies, there's a reason for commodity futures speculation. And there's a reason for commodity futures hedging. Both are needed to make a market. One last point. At the end there, Ben Carlson makes the note that a long-term bet on commodities is a bet against technology innovation. If he is speaking about just going long-only commodities, which is an absolutely asinine strategy, he's 100% right. But if you are a speculator, a trend-following speculator, who cares about whether technology wins out or not? Who is trying to predict what happens tomorrow? Why should any of us care? The only thing we should care about, if this market is going up, we're long. If this market is going down, we're short. We're not trying to have any kind of emotional attachment to any aspect of our investing. We're simply saying we're going to follow along. We're the silent partners, so to speak. Whichever way the market moves, that's the way we're going. My objective of taking a random article out of Forbes, profiling an interview, is simply to widen the scope of vision of the people listening to my podcast. I want you to see what is in front of you. I don't want you to only read the words on the page. I want you to look wider. I want you to see what is in front of you from a much wider perspective than the article gives you. Because almost every article, and I'm sure somebody can say this about me, almost every article is driving an agenda. I'm driving an agenda. My agenda is to promote and to talk about and to educate the style of trend following trading. That is so much fun to me. It just so happens that passion of mine allows me to walk into almost every corner of Wall Street and tear apart what the promotion is, what the writing is, and to offer a different perspective. Maybe you don't like my perspective. Maybe you say my perspective is 100% bullshit, and that's completely your right. But you know what? I've got more evidence than you. I've got a lot more evidence than you. You do not have more evidence. I'm not being cocky when I say that. I'm just saying if we literally want to stack the evidence up on a table and go through the pages, the trend following space is going to win in terms of an argument. That doesn't necessarily mean you're going to be a trend following trader or you want to be a trend following trader. But for those of you out there that want to compound larger returns and try to get rich, there's no other opportunity. There is no other opportunity you can pursue other than trend following that gives you such a great chance to get there. Now, of course, if one wants to just take the path of least resistance, if one just wants to shoot for the average and be like their neighbors, and this is not a knock against anybody I've commented on today or anything I've commented on today, there are other choices. You can go the buy and hold path. But if you go that path, just keep in mind, we have seen this in the last 15 years. Things can change, and they can change really, really quick. And when they do, are you going to have a strategy that benefits from that change? And if you don't, are you prepared to sit on the sidelines with no gains for 30 years, maybe longer? Absolutely is an option. Going out today, I want to play an excerpt from somebody that I've played on my podcast most recently, Alan Watts. Alan Watts is my favorite trend following trader who does not know that he's a trend following trader. Of course, he's not alive today, but that's immaterial. His wisdom is spot on. The guy is 100% brilliant. He knew human nature like not many others. This excerpt I'm going to play is about choice. And it dovetails nicely with where I've gone in this podcast. Because ultimately, you do need to choose. You can assemble all the data. Or actually, you can't assemble all the data because data is infinite. It never stops. So what is enough? What's enough to make the choice? Are you not going to make the choice because you're afraid of making a mistake? But you're going to make mistakes. We're all going to make mistakes. Making mistakes is part of the process. So if you're trying not to make a mistake, you're making a choice as well. But you're not going to stop yourself from making a mistake. You're still going to make them. So this comes down to, can you find a way to get some self-confidence? Because if you can get that self-confidence, then, and only then, can you trust your intuition?
You do not know where your decisions come from. They pop up like hiccups. And when you make a decision, people have a great deal of anxiety about making decisions. Did I think this over long enough? Did I take enough data into consideration? And if you think it through, you find you never could take enough data into consideration. The data for a decision in any given situation is infinite. So what you do is, you go through the motions of thinking out what you will do about this. But warriors are people who think of all the variables beyond their control and what might happen.
Choice is the act of hesitation that we make before making a decision. It is a mental wobbling. And so we are always in a dither of doubt as to whether we're behaving the right way, doing the right thing, and so on and so forth, and lack a certain kind of self-confidence. And if you see you lack self-confidence, you will make mistakes through sheer fumbling. If you do have self-confidence, you may get away with doing entirely the wrong thing. You have to regard yourself as a cloud in the flesh, because you see, clouds never make mistakes. Did you ever see a cloud that was misshapen? Did you ever see a badly designed wave? No, they always do the right thing. But if you will treat yourself for a while as a cloud or wave and realize that you can't make a mistake, whatever you do, because even if you do something that seems to be totally disastrous, it'll all come out in the wash somehow or other. Then, through this capacity, you will develop a kind of confidence, and through confidence you will be able to trust your own intuition. Now, this is the middle way of knowing it has nothing to do with your decision to do this or not. Whether you decide that you can't make a mistake or whether you don't decide it, it's true anyway. But you are like cloud and water. And through that realization, without overcompensating in the other direction, you will come to the point where you begin to be on good terms with your own being and to be able to trust your own brain.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.